sold the idea that financial independence is all about some number on your account statement, or even worse, that you don't qualify because of where you started out. That's just not true. It's not about some well-kept secret of the wealthy. It's about finding the right information and knowing how to apply it. On the Get Ready for the Future show, we're answering your questions so you can start making real financial change today. The journey to true financial independence begins right here, and it starts with you.
Online, on radio, and on podcast. This is the Get Ready for the Future show, as we welcome you in to answer your questions, and nothing is off limits. Anything you want to know about money, finance, investing, retirement, the government, interest rates.
Anything they want to know about the government?
I mean, we'll go for it, but I mean, I'm ready to go. I'm feeling a little spry today, but as it relates to your money, the government has its hands in that as well. But hey, we answer your questions every week. We've got 4 of them teed up once again, and they're all built, and this show exists for us to help people discover, protect, and share true financial independence. And what does that mean to you? And it might vary from person to person, but what we define financial independence as here at GenWealth is the moment in time where you have enough assets that provides a very specific amount of monthly income to you when incorporated with other guaranteed income sources that you know you don't have to work. Now, you may choose to work. It's not necessarily about retirement, but you don't have to. You know you are financially independent. So everything we do on this show and everything we do as we work for our clients at GenWealth Financial Advisors is built towards that and keeping that, sustaining that through the rest of your life. So as you think about that, that's the angle, if you will, that we're coming at answering all these questions on a week in and week out basis, Janet. So a lot of times you'll hear us say, well, it depends, or, well, you need to plan. And it's because the questions come in and give us maybe 1 or 2 items, but not enough information to fully answer questions.
And you're very on point to talk about that. We're always solving from this vantage point of how do we help you attain true financial independence. So how somebody else might answer the question, somebody else in the industry, let's say, if that's not their focal point, they may give you a different answer. But our objective is always, how do we move you toward or keep you in true financial independence?
Yep, and we're going to get to 4 questions here on today's show. But before we do, we want to kind of give you a little bit of information about our upcoming workshops and a past workshop that we just finished up. You can always go to getreadyforthefuture.com/academy. And you can see the upcoming workshops that we have on the calendar. We have one coming up very soon on October 22nd on Social Security. That one's going to be in Saline County. You can find out how to register there. We've also got another one on the election. See, we are going to talk about government. The election's impact on your money, investing in the stock market, the economy. That's coming up on October 29th in Little Rock. So I want to encourage you to go to that website anytime. GetReadyForTheFuture.com/academy. Sign up for free GenWealth Academy workshops there. We just finished one, Janet, this past weekend.
Yeah, we just finished the first ever ladies event. The name of it is Enrich. We want to enrich women with financial confidence. We believe that, and this is true to an extent for men as well, but we believe that people in general don't get the financial education that they need, and it seems to be more evident in women, but yet we control a lot of the money in our households, even though it might be in the husband's name sometimes. The decision maker is many times still the wife, and so we believe that you need to be enriched with good financial understanding and education. And so we've started this process of having a ladies event, and I mean complete with, do you call them macaroons or macarons?
You're asking me?
Yes.
Oh, I thought that was a question you kicked around at the ladies event.
I'm going to take a sidestep here. I've always called them macaroons.
That's what I call them.
I learned at this ladies event, we learned more than money. We learned that they're called macarons. So there's that. But we learned a lot about money as well. And we had some great food and good times. And lots of people there talked about that they were so excited that we had this event and so grateful for us for doing this, and that they want to bring in the future, at the next time that we do it, they want to bring their adult daughters or their adult, obviously their adult mothers, right? Right. Their adult adult daughters or their mothers or their girlfriends or whatever to bring other ladies with them because it was that impactful for them. So we're looking forward to this. We think it's probably going to be something we do a couple of times a year now. So next time you hear about Enrich, if you're a lady, come on and bring a friend. And if you are not, then find a lady who needs to know about it and send them the information. We would love to have you join us.
All right, let's dive into our questions for this week's show. And first up is Andrew via email. What is your outlook on interest rates, and how should I adjust my fixed income investments in response? Andrew, thanks for the question. First, our outlook, I would say, on interest rates is in line with the general consensus that is out there from economists, and that's basically that they're coming down. We've already seen that in mid-September. The Federal Reserve cut interest rates by 0.5 point. Now, there is not necessarily a consensus on how much and how often, but we do believe over the next year or so that rates are going to continue to come down. I don't necessarily think they're going to come down a significant degree because I do think the economy is healthy enough. The data that we read is good enough, and usually the rates are cut because there are bad signs ahead, right? They want that soft landing and they don't want to crater the economy, so they cut interest rates. I think there's enough out there for them to continue to cut, but I don't think we're going back to the types of interest rates that we saw pre-COVID for a long time, and I mean maybe ever, because those were artificially low. We're still, I've said this on the show before, we're still at a point in time where interest rates are pretty average when you take a look at the long-term history of the United States. So I think they're going to come down. But as far as the second part of the question, Andrew, you ask, how should I adjust my fixed income investments in response? And Janet, I think to start here, we need to define, because we don't know, again, back to what we said just a moment ago on the show, we don't always know what the person asking the question really means by fixed income investments.
Yeah, so when we think about investments, even if we're talking about fixed income, we would tend to, in general, think more along the bond market, that type of thing. But we know that many times we have people who come in to meet with us and they are talking about CDs and calling them fixed income investments. And technically that's accurate, but when we think about investments, we want to distinguish between savings and investments. And a CD, for us here at GenWealth, we would define more as a savings instrument than an investment instrument. So if you're talking about that, we're really we're going to go a different direction when we talk about fixed income investments on this response for you. So a CD to us is more about the return of your principal than the return on your principal. We know that you want it to be there to be available when you need it. Obviously, you want to wait until after a surrender period is up. But beyond that, it's just there for you to have it safe, not really for it to grow. But Scott, let's talk about some of the other investments that would fall really into this fixed income investment category and what we see going on there.
Yeah, and I think that's really where our mind goes when the back part of that piece was fixed income investments. We don't, as you mentioned, really consider the CD as an investment, but a fixed income investment is going to be a bond investment, and that can come in many ways, shape, and forms. But generally, what Andrew's referring to here is a debt instrument. A bond is a debt instrument, and there's some income, a yield amount that is associated with that bond. And if you are buying the paper version, the actual bond, right, it has a term, might be 5 years, 10 years, and you might get 5%, 6% on that annually. And then at the end of that term, if you hold it to its maturing date, then you will have received the money back that you started with, just kind of like a CD. You would get the yield for that entire time. Now, when it comes to fixed income investments inside of most investors' portfolios, those are more than likely going to be in funds, in bond funds like an equity mutual fund. And those are traded on an ongoing basis. So there is a change in value on that, just like there is a stock. And so with interest rates dropping, there is actually a positive effect on bond prices. Think of it as a teeter-totter. We've talked about this before. As interest rates go up, bond prices go down. The reason being is if the interest rate has risen and someone can go out and get a new bond for a higher yield than what you currently have, then the value of your bond is less. But the reverse is true too. If interest rates are cut and you're holding a bond with a higher interest rate then is available on the market, then they have to pay you a premium if they want that bond, right? So bond prices, all that to say, Janet, that the bond portfolios that we're looking at now as a piece of our client's overall portfolio, we're in a more favorable spot to be invested in fixed income than we've been in a long, long time.
Yeah, I would absolutely agree. We've seen that teeter-totter work against the bond market, and now we seem to be going the other direction. So back to your question, Andrew, about how you should adjust your fixed income investments inside of your portfolios. Another answer that we go back to so many times, Scott, is it depends. We don't know, Andrew, what your age is, what is your proximity to retirement, and also I think it's very important to consider what portion of your overall portfolio this represents. For us, taking a bucketed approach, meaning when are you going to utilize these specific assets? We don't look at a $2 million account as a $2 million account. We look at it as multiple buckets, which will be used at different points and therefore invested differently. And so the younger you are, the less you need in that bucket one, so to speak, in those fixed income investments. But the closer you are to retirement, or if you are in retirement, then you really always need to have a portion that is in some degree of fixed income to provide you that conservative income stream, Scott, that's not going to be subject to the market volatility that you might see in some of the other buckets.
Yeah, because when you think about this interest rate question, the interest rate rising or falling is going to change over a long period of time. So if Andrew is young and he needs to be in a growth strategy, he's still in the accumulation phase. Well, over a long period of time, we would say that the history tells us that the stock market is going to outperform the bond market, right? It might be over a short period of time that fixed income outperforms the stock market, right? But if you're looking at that long-term approach, and as Janet has mentioned, identifying that is determined by when do you plan to use these dollars. And if Andrew's 40 and he's going to retire at 65, we've got a 25-year time frame. So really tweaking a little more fixed income here, a little less fixed income here is probably not as appropriate as it is when he is 64, about to retire at 65. It really comes down to an overall investment strategy, Janet, rather than just saying, how can I make a little more money for the next 6 months?
Yeah, that whole deal, we talk sometimes about timing the market versus time in the market. It's the same type of concept on this. Let's not try to play the game of, this just adjusted in my favor if I buy that investment. It needs to be slow and steady wins the race. Yep.
The overall answer to your question, Andrew, is to plan and to determine where you are on your path to financial independence and how fixed income might be appropriate for some of your portfolio. Thanks for the question. Next up, it's Caroline from Fayetteville. I'm 57, and I've had an advisor for a long time, but I realized recently the only strategy he really has is some version of the 4% rule. Now, I'm worried whether I'll have enough. I have about $715K in my IRA, plus an additional $100K or so in my employer plan. I'm planning to retire at 65, but who knows what the future holds. How do I know if I'll run out of money? Well, Janet, it's great that Caroline is asking this question because, when you think about where she is and based on her age now and where she wants to retire, she's still got about 8 years before she's planning to need some of this money. And that is kind of the time you start to wonder, but nothing's gone down lately probably, right? So the market's been going up and up and up over the last couple of years. She has lived through 2022. Her account value probably looking pretty good, but it's very smart to be considering now because she is in the retirement red zone, which we define as less than 10 years away from retirement. It is very appropriate to think about not just the investment strategy, but the withdrawal strategy that should go hand in hand.
So we're going to talk, Caroline, about a risk called the sequence of return risk, and we've got a couple of scenarios we'll go through comparing two different investors. The first answer to your question that I will give you on how do I know if I'll run out of money, the answer in using the 4% rule is you don't. And that's a dangerous place to be, frankly. And I want to help you understand that a little bit. So let me walk through a specific scenario first, and then we'll compare a couple of other investors. So let's say that you have $1 million, and you're using with your advisor, and to be clear, this is not what we do at GenWealth. We take a very different approach to retirement income planning. But let's say that your advisor is using that 4% rule. So on your $1 million, if you withdraw 4%, you're going to withdraw $40,000 a year from that. And you rock on and you're withdrawing $40,000 a year, and it's all good until it's not. So along comes let's use 2008 as an example. Along comes a 2008. The market is down 40%. So now your $1 million is not $1 million. You're down to $600,000. So going back to that 4% rule that your advisor is using, you have a choice to make. If you continue to take 4%, then 4% of $600,000 is now no longer $40,000, it is $24,000. I have yet to meet a retiree who wants to take a $16,000 pay cut,
right,
especially in the face of inflation as we see it. The other option that you have is to say, I'm not going to take the pay cut. I want to continue to take my $40,000, which, by the way, is still not going to help you on inflation because you're taking the same amount that you were last year. But it's now $40,000 of $600, not out of $1 million. So that is a 6.7% withdrawal rate, which is inordinately too high, and you will run out of money. So the reason I say that you can't know with a 4% rule if you're going to run out of money or not is you don't know the type of market you're going to face, particularly early in your retirement. And Scott and I are going to go through comparing a couple of investors, one of whom has some positive returns initially at the very beginning of their retirement, and the other one has slightly negative. Scott, it's nothing close to a 2008 type of scenario,
right,
but still runs out of money only 16 years into or 15 years into their retirement.
Yeah, and for our viewers online, we can show you that graphic. We'll talk through it for our audio only listeners, but this is basically a lineup of investor A and investor B. They both had the same amount of money, $500,000 to invest. It was invested in a 60-40 allocation. So this is not all in on the stock market. This is meant to be a balanced portfolio, 60% represented by the S&P 500 and 40% represented by the bond index. And so you think it's a pretty stable or balanced portfolio. But if you assign actual returns to the years of their retirement and take a look at the only difference between investor A and investor B was the year of their retirement, you see very different results. Investor A started with $500,000 and retired in 1966 and got pretty, not a really negative return, but about 5.3% in year one, then followed it up with a couple of good years, but then had another negative return. If you follow that column all the way down to age 81 in 1982, he was out of money.
Yeah.
Okay, so completely exhausted his funds between 1966 and 1982. Now, investor B, on the other hand, same amount of money, same investment strategy, different retirement year. 1976, so 10 years later, got different returns, a big 20.9% return in year one, and then if you look at the same time frame, age 81, she actually has $1.2 million. So the difference in $1.2 million and nothing is simply the sequence of return on your investments. And there's data out there, Janet, that always floors me that it doesn't even have to come down to the year. It can be the month.
Yeah, it can be.
So when you talk about the market you're retiring into, it's not even necessarily the overall market. The market might have a fit 1 month, and you have a problem getting the returns back.
Scott, you and I have seen the data on if you miss the top 30 days in the market and over decades of time, the impact that it can have on your account. And I had two coworkers. They don't know this because we're not allowed to share the details about other people's investments, obviously. But I had two coworkers who came to me 2 weeks apart in the exact same investment with the exact same allocation, and they both did fine. It was good, but one of them did inordinately better than the other because they happened to hit one of those really good days, in the 2 weeks that the other one wasn't in there.
Wow.
And so that's on the positive side, but
Yep.
it absolutely can happen in this scenario. On the negative side, if you're using that 4% rule, it can destroy your retirement. And the challenge is, I don't care who your advisor is, I don't care how good they think they are, how good they really are at what they do, nobody knows the type of market you're going to retire into.
Right.
That we do not have, nobody in the industry has a crystal ball to protect that or to predict that. So you have to protect yourself against the type of environment that you might be retiring into. And we have some strategies that we use on that we're going to talk about. But one other point that I think we ought to hit on, Scott, is Monte Carlo simulations that a lot of advisors will use to predict the probability. And I know you used to be on the news and you would sit next to the weatherman.
Right.
And I kind of feel about Monte Carlo probabilities like I do about the weather prediction. Now, y'all, I love me some Todd Jacobian. He's a great guy. But he'll tell you as much as I do that he's not accurate 100% of the time.
That's right.
There's no way. And that's just the nature of the beast. And the same thing in predicting the markets. Nobody can do that with 100% accuracy. There's no way. So if you were to get on an airplane, Scott, and the pilot comes on before you take off and he says, hey, we're ready for our flight. The tower's going to tell us to leave here in just a few minutes. We're just waiting for our turn. By the way, I was just looking at the details on our probability of success, and we have an 85% chance of making it to our destination and everybody being alive when we get there.
Sometimes I think that's probably happening. They just don't tell me.
Yeah,
But-
yeah. I don't want to know. I'm flying somewhere next week, Scott.
I don't want to know. I don't want to know. But yeah, I mean, that's the point we're making here is you don't want your financial independence depending on some 80%, 85% probability. And that's what that Monte Carlo simulation is. It's, hey, we're going to run all these potential market environments and returns that we could possibly get, and would the portfolio withstand it? What's the probability that the portfolio is going to withstand it? And if you come out at 80 or 85%, that's considered good in that simulation. But we don't think that's the way you should plan for retirement when it comes to a draw strategy.
If you were on the airplane, you'd get off.
That's right.
And if I were that investor, I would change the plan. So the question is not, what's my probability of success? The question is, how do I negate the risk?
Yep.
And if you can negate the risk, then you're good. Okay, so the way that we do that here at GenWealth, there's two elements that we really focus on. It's called a flooring and bucketing strategy. The flooring, Scott, we live in Arkansas, and we have had our fair share of tornadoes in our lifetimes. Mm-hmm. And I think that we have both, as have many Arkansans, we have driven past at some point the remainder of a house, meaning it is just the foundation. Everything else has been blown away, but that foundation is there. A tornado can't take the foundation away. It's not going to pull it up out of the ground, okay? So we want you to also have some foundational income so that when a financial tornado comes, like a 2008, that you are able to still have that solid foundation, that you have the money for the basics that you have to have for food, shelter, clothing. Those things are needs that you're always going to have. So how do you go and say, how do I pull off part of my investments and set that aside to make sure that I always have a guaranteed foundational level of income?
Yeah, it's the income you cannot outlive no matter what financial tornado happens. And a part of that Social Security. It may be pension, but if that's not enough, you can use some of your assets to buy an annuity, which we've talked about before, and we won't go into because that's a long discussion. But those are instruments that provide a lifetime income that can be stacked on top of Social Security and potentially other guaranteed income sources, so that you know you're getting a monthly check for the rest of your life, no matter what financial tornado hits. Past that, once we know we've got that box checked, right? The basic lifestyle in retirement is going to be sound no matter what tornado hits. The next piece is the living rooms of the house and the memories that are made And that part is your discretionary income. We call it desired income. And that comes from the investments. And rather than put it into one pie, one circle, and pull out of it indiscriminately, we want to control what we sell and when we sell it. And the way to do that is the bucketing strategy. So the money that you're receiving in the first years of retirement is in a very low-risk investment. We're not trying to kick the wheels off of the vehicle and run it so hard that we're going to get some phenomenal rate of return, because that comes with risk. And we want to control what we sell and when we sell it, so that we know that when that money's coming out on a monthly basis, you can reasonably assume that you're going to not see it exposed to a loss.
Scott, you can circle back to the buckets in just a second, but I want to point out that what you're talking about here is that fixed income portion that we were talking about with Andrew earlier in the show. Mm-hmm. So tell us the rest of the bucket story. Yeah,
so the rest of the buckets is each bucket that we step out in time frame into the middle, we're taking on a little more risk, and we're bridging the gap toward the growth investments. We call it a hybrid strategy. It can be an alternative strategy. And then on the outer buckets, where you're in the market, where you're all in with your growth mode, you're not planning to actually utilize those assets as income for about 15 years. So anything that happens in the market has 15 years to recover, so that you don't have to sell while the market's down. And we know that's a length of time that, historically speaking, the S&P 500 index has never been negative over that 15-year time frame. We know that it's not guaranteed that it won't be moving forward, but we do know that time generally heals all wounds in the market. And I tell clients all the time, Janet, that retirees will come in and they'll tell us, I need to be safe with my money because I can't afford to take a loss. I don't have time to make it back. Well, actually, in the bucketing strategy, with a portion of your portfolio, you're still 40 years old, right? You're still 45 years old. Yeah. You're still in accumulation phase with that piece.
Well, this is a good time to be telling this story, because we talk about 2008, that was just the wheels fell off the bus in terms of the market being down 40%. That was very much a worst case scenario, but the low point was actually not in 2008. It was in 2009, March of 2009. And so guess what? In 2024, we're 15 years out from that. Yeah. So if you had been using the bucket strategy, we would just now be starting in that bucket that is more growth oriented. So at the time, the growth buckets would have looked kind of ugly. But if you don't need those growth buckets for 15 years and you have your foundational income in place on a guaranteed basis, and then on top of that you have your desired income coming from more conservative investments that are not exposed to that market volatility, then it just doesn't matter, and you give it time. We joke about this, but it really did happen with some couples. We'd have couples coming in and telling us, in 2008 and in 2009, when so many people were in a panic, they'd come in and always there's one spouse that gets it a little bit more than the other one does, and one is more prone to kind of panic about things like that. And I can't tell you how many times that they would come in for their review and they would say, we were talking the other day about, turn the TV on and they're like, the Dow plunged, the market is horrible, and all of these bad things. And one spouse is going, oh my gosh, honey, what are we going to do? And the other spouse looks at him and says, hey, remember the buckets? Like, we don't need that money for 15 years. Where do you want to go to dinner tonight? Mm-hmm. And that was it. And it really is the game changer.
Yep, absolutely. This is our question of the week. So congratulations to Caroline. You can tell we liked it. We spent a long time talking about it.
We did.
We'd love to send you a free Get Ready for the Future show tumbler. For being the question of the week, we just need you to email us, show@getreadyforthefuture.com to claim it. And if you have questions for us on the show, you can call or text them to us at 501-381-5228. Or you can send an email to that address that I've already mentioned, show@getreadyforthefuture.com. And I'm sorry I was incorrect earlier today in the show. I said we had 4 questions. We're not going to be able to get the 4 questions. We're only going to be able to get the 3.
We'll save it for next week.
And Keith from Benton has the honors of being our final question on the show today. And Keith writes, I'm 62, and I have a paid up universal life insurance policy. Should I keep it? Keith, thanks for the question, and let's define what paid up is. That sounds really good, and it is really good. but you don't really ever stop the premiums here. It's not like
Right.
you've reached a point where the insurance company says, you've given us enough money, please stop. What it does happen with a universal life policy in most cases is that the cash value that you have built over the time frame of sending those premiums in has now accumulated to a high enough degree that if you wish to turn off your monthly premium payment, your cash value will now take over and start to pay it. And that's nice, but if you think about the way that works, all these years you've been paying it. That's your
Right.
money. Now, it's probably grown some with interest, of course, but you could have been putting it all towards the premium in a term policy, but we'll get to that. But the question Keith has, should you keep it, I think depends really on his situation in life.
Yeah, so let's keep talking a little bit more about that cash value. So internally in this policy, what you actually have happening under the surface is an annual renewable term. What that means is that the cost to insure you as you get a year older every year is a little bit higher. And so when the insurance company starts to use the cash value that is set aside to pay for those premiums each year, that is going to get depleted a little bit more and a little bit more because you're a little bit older. So over time, it has the potential, and we've seen this happen. We don't utilize this type of insurance policy. If we need insurance at this stage of life, we would go with a guaranteed universal life, which will not get to the point that I'm about to tell you on this. Some of these will get to a point where the cash value is depleted, and we have seen people come in where they have a terminal illness, but they're still here for now. But the policy is at a point where they've gotten a letter from the insurance company that says, "Hey, your cash value is now depleted. Either you can let the policy lapse, or you can pay us this exorbitant amount of premium to keep it." And they're in a situation where they truly can't pay because they've been using that money to pay for health issues and all the things, and so they're just in this catch-22 that it is horrible emotionally. So that's a reason that we just don't utilize that type of policy. That being said, though, you do have some opportunities here, Keith, and this is something I'll just go ahead and share my dad's story on this. I have on myself, I've only ever had term insurance that has been the way that I could get the most coverage for the least amount of money and use the rest of my money to do other things like investments. But my dad did not grow up in that same time period, and so he had a cash value policy. And they got to a point where they were self-insured. And Scott, he had been taught that you always need insurance, and so he thought he needed to keep it till death do us part. And I remember sitting down with Mom and Dad and having that conversation that, hey, you don't really need to keep this anymore. And I looked at my mom and I said, listen, if he cancels this and he gets hit by the proverbial bus next week, you're not going to like me. But if he doesn't, if he's here for a longer period of time, this is the better place for you to go, financially. So they took that money that would have been in that life insurance policy and just stayed there to pay his future premiums. They were self-insured, didn't need the death benefit anymore, and they took that and invested it. And that can be a game changer. It's not right for everybody, but you do need to consider it.
And that's the big thing, Keith, is could that cash value be better utilized in some other place? And the answer to that comes through the planning process. You may still need the death benefit. You may still need the cash value, but a 1035 exchange could take it from one insurance policy to seed another that might not be even with a death benefit, could be for long-term care. You could also use it to pay off debt. So lots of things that you could work through there, Keith, and I would advise you to reach out to a financial advisor. We'd be glad to help you walk through that here at GenWealth. You heard the bell there in the background. It's time for our final thoughts.
I think for my final thoughts, I'm going to circle back to Keith a little bit more on this. Keith, at 62, the type of insurance that you need and the reason that you need it might shift. And Scott talked about this a little bit, but you have needed life insurance to guarantee your income to be replaced if something were to happen to you. But you're probably approaching retirement at this point. And so I would say that the greater risk at 62 is a long-term care event. So it is really worth considering whether that shift makes sense. And that does not have to be a taxable event for you.
My final thought is an upcoming workshop. We talked a lot about the floor, the foundation of your retirement income. That may need to be some of your assets to purchase a guaranteed income product, but a big piece of that for folks today is still Social Security. And I say still because 1 in 3, 1 in 2 of the people that come into our office are going to ask us, is it going to be there? We're going to talk about that and how Social Security is a big part of your overall retirement at our Maximize Your Social Security workshop. Coming up October 22nd at 6:30 at the Summerwood Sports Center in Alexander. That's just before you get to Bryant. You can visit getreadyforthefuture.com/academy to sign up. It's free to attend. And also at that web address, you will see all of the other workshops we have coming this fall. We are out of time for this week's Get Ready for the Future show. Thanks for sending in those questions, and if you have one, get them to us. You can leave a voicemail or shoot us a text at 501-381-5228 to hear your questions answered on the air next week.
The GenWealth financial team is available to you 24/7 at info@getreadyforthefuture.com or call our offices at 866-653-PLAN. That's 866-653-7526. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Securities offered through LPL Financial. Member FINRA SIPC. Investment advice offered through Independent Advisor Alliance. Independent Advisor Alliance and GenWealth Financial Advisors are separate entities from LPL Financial.